An absolute bombshell hit the financial world last week, and it could have a major impact on the direction that the housing market is heading in, potentially even leading to the market doing a complete 180. So in case you didn't hear, there is a US banking crisis right now in which many banks over-allocated customer funds, mostly into assets that have fallen drastically in recent time, like government bonds. Now this has led to losses being inflicted, putting some banks in a position where they don't have enough money to pay out customer withdrawals, leading to bank runs taking place. So far there have been 3 banks which have completely collapsed: Silvergate Bank, Silicon Valley Bank and Signature Bank. However, there are major concerns around other names right now, like Credit Suisse and First Republic Bank, as well as the overall banking sector in general. So for a little while now, we have seen the housing market steadily fall every month, and according to the Case-Shiller Index, it is now down by 2.7% compared to the peak that we saw in June of 2022. We've also seen the average mortgage rate surge to insane heights since the beginning of 2022, making it much more unaffordable to purchase a home. However, all could be about to change in the housing market as a result of what has been happening in the banking sector over the past week or so. First of all, this banking mess could lead to lower mortgage rates. Now, the main thing that has caused all of this carnage is the sheer speed at which the Federal Reserve has been hiking interest rates. Simply put, if the baseline interest rate rises, then fixed income government bonds become less attractive because you'd be getting a higher yield simply by putting your money in a bank. Now, as a result of this, the market has reacted, and we've seen government bonds fall quite sharply in price in order to offer a higher yield and be more competitive with just keeping your money in a bank. Now, if the Federal Reserve continue to hike rates aggressively, then government bonds are only going to continue falling in price so that their yield comes back in line with interest rates. Now, we know that the banks keep a lot of their assets in these fixed income government bonds, so if they continue to decline in price, then that will obviously lead to them losing even more money on paper. Now, if the liquid cash that the banks do have on hand becomes too low, then they will be forced to sell off some of these government bonds to recoup cash in order to pay out on customer withdrawals. But as we saw with Silicon Valley Bank, when a bank locks in its losses for all to see, it leads to them having to raise fresh capital to cover the hole, which in turn panics both investors and customers of the bank, which causes a mad rush for the exit, with customers pulling funds out of the bank and investors selling their shares. Now, it can become a brutal downward spiral until the bank totally collapses and has to declare bankruptcy because they don't have enough cash to pay out on their deposits. The Fed knows that hiking more and more could cause a domino effect of many more banks collapsing, so is therefore much more likely now to be less aggressive with their interest rate changes. We're facing a very real possibility of no more rate hikes at all, or depending on how desperate the situation is, we could even see interest rates be cut. Now, this would relieve pressure on the underlying value of fixed income government bonds, and therefore relieve pressure on banks who hold large amounts of this particular asset. Now, mortgage rates were facing the prospect of rising even higher if the Fed were to continue to hike interest rates. However, this is now looking much less likely. A pause in rate hikes or even a rate cut would lead to mortgage rates falling too, which would of course be a great thing for the housing market. Lower mortgage rates means that borrowing money to buy a house is much cheaper, leading to an increase in housing affordability and an increase in housing demand. This would therefore put an unexpected upwards pressure on house prices. The second major thing that goes in the favour of the housing market is the fact that the Fed has just started increasing the money supply again. What you're looking at here is the Fed balance sheet for all assets over the past 5 years. And as we all know, money was printed at a record rate and pumped into the economy after the pandemic hit as a way to prop up the economy when many places were shut down and people couldn't work. This increase in new money, known as quantitative easing, continued well beyond the sharp surge that we saw in 2020, and this was up until spring of 2022 when the Federal Reserve started to reverse this process and take money out of the economy in the form of quantitative tightening. Now, assets had declined by around 8% as a result of quantitative tightening, which was creating a money supply contraction. Now, when the money supply contracts, this is generally a bad thing for assets like stocks and real estate because there is less liquidity in the market, less money in general sloshing about, and the demand for these assets is therefore falling. So we've been in a period of quantitative tightening now for close to a year. That was until last week, and we've just seen the Fed pump a fresh $300 billion into the economy in order to help bail out banks and make sure that customer deposits at the banks can be 100% reclaimed, as seen here on the total assets chart. Now this has essentially erased a good portion of the progress that had been made over the past year or so through quantitative tightening, and means that we are technically now back to quantitative easing. This big pump of money into the economy last week is likely to contribute in a positive way to inflation and asset prices like stocks and real estate. If money is required to be pumped into the economy in the future, maybe because more banks get into trouble and need to be bailed out as well, then this is only going to drive asset prices up even more, which positively impacts the housing market. In fact, there are 186 more banks that may be prone to similar risks that Silicon Valley Bank suffered, according to economists at Wall Street Journal. Now, according to this research paper, 10% of banks have larger unrecognized losses than those at SVB, nor was SVB the worst capitalized bank, with 10% of banks having a lower capitalization compared to SVB. Even if only half of uninsured depositors decided to withdraw, almost 190 banks are at a potential risk of impairment to insured depositors, with potentially $300 billion of insured deposits at risk as well. Now, if uninsured deposit withdrawals cause even small fire sales, then substantially more banks are at risk, and as we saw last week, $300 billion was printed to bail out just Silicon Valley Bank and Signature Bank as well, meaning that if more banks do fail, then this number could rise drastically. It really is scary to think about how much more money would need to be printed if even 10% of these 186 supposed banks at risk were to collapse. And if the US government has to bail all of them out, then this sum of new printed money could reach the trillions. We also recently saw the real estate research firm CoreLogic come out with bullish remarks on the housing market recently, expecting US home prices to rise by 3% between the end of 2022 and the end of 2023. Now, if they are correct on this prediction, then home prices will be right back up to levels that we saw at the height of summer of 2022 during that boom period. And CoreLogic do believe that home prices should be nearing their bottom around about right now, with Selma Hepp, the chief economist at CoreLogic, stating the continued shortage of homes for sale is likely to keep price declines modest, which are projected to top out at 3% peak to trough. Home price depreciation and strong income growth are expected to boost affordability, which is particularly important for first-time buyers. This group has accounted for a higher share of mortgage applications since the summer, as first-time buyers don't need to surrender an extremely low mortgage rate like current homeowners. So we know that the demand for housing could increase as a result of lower mortgage rates and a higher money supply, and as CoreLogic hinted there, the supply side could also go in the favour of rising housing prices as well. Digging deeper into the supply side of the housing market, looking at this Redfin data, we can see that the housing inventory has been declining in recent months, and although some of this is due to seasonality, we're now at a supply level of around 695k, which is much lower than the 950k that we saw in summer of 2022. Now, this declining supply is also echoed on Fred data, which has taken a bit of a hit. The months of supply data backs this up as well, and although we are still higher than during 2021 and early 2022, we've taken a sharp fall from the sort of supply levels that we saw in early 2023 and late 2022. The amount of housing supply on the market right now is not rising, and in fact it is still pretty low historically. If we are really facing a situation where demand for homes could drastically rise in the future, then supply is in a position where it's not going to push back much against this rising demand, which could lead to the housing market rising by a quite considerable amount. Now, I must clarify that this would almost require a perfect storm of events to happen, and even then it may not play out just like this. We may not see any more banks actually fail, which means we may not be getting declining mortgage rates or any more money being pumped into the economy, which would therefore mean that we wouldn't get any rising demand. But even if we do witness a large-scale collapse of US banks, then we will likely have bigger problems on our plate than what the markets are doing. Plus, are people really going to want to go out and start buying homes when we are in a period of massive uncertainty alongside potential economic collapse? Not to mention the fact that there are still a lot of other things on the supply side which could also change, like home builders finishing off developments and offloading fresh supply onto the market, something that I expect to happen over the next year or so, given the number of homes under construction right now. I did actually make a video going into more depth on the banking collapse, which if you want to check out, you can click on the screen right now. Aside from that, please leave a like on the video if you enjoyed it, that does help out the channel a lot. Also drop me a comment as well, let me know what your thoughts are on the housing market and where it could head over the next year. and also subscribe too if you want to see more videos similar to this in the future, and thanks a lot for watching.